he has worked. 235, 240 was a good support zone. We are seeing a rebound from those levels. So in case someone wants to enter, I think this is a good opportunity. At those elevated levels of 270, 280, it was seeming, a little overstretched. We were seeing negative divergences. Those have played out, and the stock's actually seen this round of profit booking, which is a very healthy sign. So from a near to medium term perspective as well, I think this is a good buy. You might want to place your stop losses slightly deeper, maybe in case you want to factor for volatility. So in that case, 230 will be your stop loss. On the upside, you're looking at 275, which was the recent high, close to the recent high levels all over again. And once that is taken out, momentum will kick in, and 295 is the next level to watch for. So from a near to medium term perspective as well, this dip has been a welcome one, and I think the stock is ready to resume its uptrend from here on.
On that note, let me start the queries with a caveat that we are awaiting a conversation with the management of Raymond Lifestyle, and that will come to you at 11:40. But on that note, incidentally, we've got a query, the first one today from Kunal, who's asking about Raymond Lifestyle. What's the call on this counter? For context, it was listed today, the first step of the demerger from Raymond that will split into 3 separate entities. Avinash, it listed at over 3,000, and then since then there's been selling. I guess to a certain extent one would assume that this is profit taking. If you have the opportunity to buy though, would you do so right now, or would you wait for some time?
No, I think, Alex, it's always better to wait for some time, because typically whenever a demerger happens, I think the stock takes some time to settle down. The markets would like to await the commentary from the management and look at hard numbers, at least the financial data point numbers from this independent entity. Although one thing is very clear, that they have a very strong business model, right from the fabric to the garmenting. And there is a very big opportunity in the urban lifestyle, space. I would believe that there is definitely good value to be made, but I think it's better to wait for the management to come out, clarify their position, and I think look at least the next 1 or 2 quarter numbers, because that is going to re-rate the stock in the longer term. In the short term, the stock is going to be purely governed by demand supply, mechanics. And I think currently what we are seeing is a little bit of profit booking from the initial listing price. So longer term, yes, but short term, I think the stock will be volatile.
Yeah, volatility, brace for volatility. By the way, investors in Raymond have gotten 4 shares for every 5 shares held in Raymond Limited. A lot of the new investors are trying to get into this counter, of course, but let's listen into what the management had to say to my colleague Mahima.
I think it's a very momentous occasion, obviously, for us. Very exciting times. Now, it's obviously not prudent on me to put a number to it, because finally it's the investors who put a number, and the price discovery happens accordingly. But I can tell you the opportunity which we have as we are unlocking this Raymond Lifestyle Limited as a separate entity is that we are maybe the only business in this space which gives the opportunity to investors to invest behind 4 verticals at the same time. One is a core branded fabric business, which has been there for almost 100 years now. We have taken our EBITDA margins to a record 20% plus, which is almost like a FMCG EBITDA margin, and that can be a comparative indicator in mind by putting valuation to it. Another business that has transformed really in the last 2 years, the branded apparel business, where again we've reached a EBITDA margin of good double digits, and the business has grown at a very high pace, and that's where we're talking of another 800 plus stores over the next 3 years. So the headroom to grow is immense for us there in terms of both revenue and then improvement on EBITDA margins also would happen. Then comes the third vertical for us, where we are moving in a pretty big way, is ethnic wear. Now, no wedding in India is complete without Raymond in any case. Now, there's this big fad Indian wedding which is taking shape over the last decade. Ethnic wear is coming to its own, and we've launched this brand Ethnics by Raymond, which again would scale up to almost 400 stores over the next 3 years, and that will add its own value in terms of valuation, and again there can be a comparative indicator one can take into account, and I think we've created a very good package out there, and the signs are very, very good for us there. Then comes our fourth business, which is a B2B garmenting space, where we have one of the world's best facilities in terms of 12,000 skilled workers churning out top-end garments for the best global brands. We have seen huge tailwind out of China Plus One. Bangladesh Plus One is playing out. We are the world's only vertical integrated player out there, and again that's a disruptive growth business for us. So if you see put together, these are 4 different verticals which give a great opportunity for growth across. And if you have to put a valuation, I would just say put comms to each and every vertical, and then you'll see the valuation which Raymond has.
Absolutely. Mr. Katari, you're also going big when it comes to the ethnic wear business. And roughly as per my calculations, the margins stand at 22 to 23% right now. But, the margins can have a lot of headroom when it comes to the ethnic space, even if you compare it to your competitors. So I want to understand that going forward from a long-term perspective, where will the margins go at from this 23% mark from a longer-term perspective, let's say by FY28, and what will be the levers exactly?
So I'll tell you, first of all, the EBITDA margin currently would be not, there's not a right way to look at EBITDA margins because it's a business we just started. Okay. We'll be in an investment phase for scale up on this business for the next 3 odd years. I can tell you what is a good indicator right now, actually the gross margins we have. Okay. Our gross margins are much, much higher. I mean, I would say we are the closest to the best in class in terms of gross margins. And this is despite having a much more superior fabric, much more differentiated designs. So what we have done a very good job along with the design package, the retail stores, I think we have made a very good job of our sourcing there. So I think at this stage when the brand is in a large investment phase in both store expansion as well as marketing, the best indicator to see is your gross margins. And they are way up there in best in industry. And we are very confident once we have done this investment phase is over and we have scaled up to 400 stores, then our margins will be best in class.
Okay, and in terms of your new businesses that you're undertaking, the innerwear and the sleepwear business, what kind of margins you're expecting there?
Again, I would say the whole strategy is built on while scaling up apparel, garmenting, strengthening fabrics, building the new. So when you're looking at new businesses, I think my first focus is to really scale up the businesses to a multiplier level. One thing I can assure is that none of these businesses would be such that they'll keep on bleeding beyond 3 years. They will not. They will be very, very healthy margin business in 3 years' time. They are two very different strategies. Sleepwear is a strategy where we are looking at disrupting the value part of the segment. Okay. And there the cost, really the spends would be really more behind distribution and pricing. Okay. And we have given a very good product at affordable pricing. And I think that itself will drive growth. We may not do a very large spend on, let's say, marketing for long term because that is also a multi-brand distribution. Innerwear would be again a mix of both multi-brand distribution and our own stores. So I think both the businesses, again, along with ethnics, building the future vectors of growth, large expansion, we will stabilize, we'll break even in 3 odd years' time and we'll stabilize at very healthy margins.
All right, that is the management of Raymond speaking to NDTV Profit. Now, let's turn back to the questions that you've sent in. And by the way, that number that you see on your screen, if you're tuning in right now, that's where you send them to us. We've got Jaya from Bengaluru who's asking about Orient Technologies, which she's bought at levels of 315 rupees per share. She's wondering if this is a good stock to hold for the long term. The stock is not too far away from the buy price. Avinash, do you have coverage, first of all? Have you looked at this company? And if so, would it be a hold for you?
Yeah, I think, Alex, this company, first of all, is a well-established IT vendor and has a very good clientele, both in India and abroad. And most importantly, it's got an order book of almost 600 crores plus. So I think revenue visibility is pretty strong. And, the stock is trading at 305, 306 levels. If the investor has a 12 to 15 month kind of time horizon, I would suggest, let the stock settle down. Let us get, maybe a couple of quarters numbers from the management. And once we get a better hold on the management commentary, I would not be surprised that you could see a recent amount of re-rating happening here. So consider it to be a good investment, for at the current level. And I think one can definitely consider holding it for the next 12 to 15 months. I think you should be able to get a decent risk reward.
All right, Tenzuk from Kerala has got a question on Larsen & Toubro, but he's also asking an interesting question. Will the drop in crude oil prices have an impact on electric vehicles and the stocks related to them? Interestingly, the drop in crude oil prices and the kind of volatility that you've seen in crude oil prices have not reflected in a change in the prices at the pumps, as a result of which the same cost is being incurred by people who are driving internal combustion engine vehicles. So it's not really that is affecting the cost of electric vehicles. It's more about the SOPs, and FAME 3 is on the way. That's something to watch out for. Larsen & Toubro for the at the current level for an intraday trade. What's the view, Kush?
Not really, Alex. And I mean, this is not a stock that you generally trade in. It's more of a, an investment kind of a counter. But even if you look at from a momentum perspective, the stock's trading in a very broad range of 3,500 on the downside and about 3,750 on the upside. The current bias is mildly negative, and there's a cluster of support zones around the 3,600 mark. So it's just barely hanging on to that support zone. So I think you could perhaps give it a miss from a near-term trade perspective on the long side, and Larson's not a counter that you want to go short on anyway. So from a trading perspective, Larson's an avoid at the moment.
Hariom Karnal from Haryana has got the next question asking about Zomato. We've already taken questions on Zomato. And he's asking about M&M, Mahindra and Mahindra, and whether or not to buy the current market price for a period of 1 year. I'll come to you, Kush, on this one. Would you buy it at the current level for a 1 year period?
For a period of 1 year, yes. And I'll tell you why. We've been talking about this for a while now, Alex, that the stocks had a stellar run. It's now gone into this consolidation mode. Now, you ideally, when you want to buy is when such stocks are either in consolidation or seeing a round of profit booking. That's what Mahindra and Mahindra is doing. However, that said, what I would also suggest is that there is this mild downturn that the stock has gotten into, and it doesn't seem to have really created a very strong base just yet. So if you want to buy it for a year perspective, my suggestion would be to spread it out like an SIP over the next 2, perhaps 3 months, and get a better average price, because the downturn doesn't seem to be complete yet. The 20-day moving average band is being respected. However, today the stock's crossed below that. So my suggestion, yes, you can accumulate, but it needs to be done in a staggered SIP manner.
All right. Marut from from New Delhi is asking this next question. He's asking specifically to you, Avinash. He's directing it to you. The view on PVR Inox, he's looking for actually a tech and fund now view, but then the fundamental view I'm going to you for. He's bought at levels of 1,450. He's in the green right now. What would you do? Would you hold on to this one?
Yeah, I think, see, Alex, within the multiplex space now, PVR Inox is the largest player. It gives them tremendous pricing power. And obviously, the geographical reach is now going to be extremely solid. So I think, if the investor has a slightly medium to long term view, I think he should hold on, because the timing, what he has done is probably a right timing for his acquisition price. But if you look at the business model, if you look at the growth prospects of the Indian cinema industry and the kind of growth potential, over the next couple of years, this could become a very good wealth creator. But I think one needs to understand that you need to spend a little more time here. In the near term, the stock may remain a little bit range bound. But over the next couple of years, I think the entire business model would generate a lot of free cash. And obviously, the Indian cinema market is a very big market, not only India, but even globally. I think, markets have welcomed Indian cinema very well. So this benefit will obviously come to PVR Inox. You just have to give in some more time.
Okay, fair point. Sastamani has got the next question. He's writing in from Coimbatore. He's asking about EIH Limited, which he's bought at levels of 386.5. He's wondering whether it's worth holding for a period of 1 year. He's in a loss right now. Not a very substantial one, but still. Would you hold, Kush?
Well, this entire space is looking like, there's a turnaround on the cards. Well, EIH in particular, if I see there is, a very clear base formation and an attempt to revive. Now, the base formation is happening close to that 365 mark. So what I would do is I would have a stop loss at 365. In case that is broken, then, you're better off exiting. But, there seems to be an attempt at recovery. Now, where will that recovery come? Perhaps, once 390, is crossed and you sustain above that mark, is when you could see, recovery coming in. There is marginal uptick on volumes today. So as I said, there could be this push that the entire sector is receiving, plus the base formation into play. So hold with a stop loss of 365. I think on the upside, you're looking at 405 and then perhaps the 430 also as targets if you can hold it for, let's say, a couple of months time frame.
All right, Viraj got the next question. Viraj Dhamija from Saket in New Delhi is holding PNB Housing Finance at a price of 900 or thereabouts, and he's wondering whether he should hold or exit. Since it's a hold or exit question, I'm coming back to you, Kush. Would you hold on to this?
What I would do? I would actually take part profit home on this one. The stocks had a stellar vertical run over the last, about 15, 20 odd sessions. And today, after a while, we are seeing a sharp round of profit booking on this one. and it's not abating just yet. Now, since his buying price is close to 900 and he's still in a decent profit, I would take part profit home. So book 50%, hold the rest, because here too we've seen tremendous action. This is the first day of profit booking, so no panic should set in ideally. But you wouldn't want to perhaps see a seller run and then exit at cost or maybe lower, right? So exit partially, hold the rest with your buying price as the trailing stop loss. And once this round of profit booking is over, I think 1100 and other higher levels are very much possible in PNB Housing Finance.
All right. We're looking at Kolte Patil, which is the Pune-based developer, next. And this is a question to you, Avinash. We've got Vishwanathan Nair, who is writing in from Cochin, and he's bought at levels of 411. What's the view here? Because Pune is a growing market. It's actually seen tremendous development in the recent past. Would you hold on to this, and what are the prospects for this stock?
No, I think Kolte Patil, as you rightly mentioned, Alex, is a large player operating in the Pune market, but now they've entered the Mumbai and the Bangalore market also. And I think, looking at the kind of inventory and the kind of projects they have been betting on, specifically Mumbai, Bangalore, and now, of course, existing Pune, I would not be surprised that, if the investor can give in some more time here, maybe next 12 to 18 months, the real estate markets have been doing pretty well. Inventories are also moving pretty fast. And most importantly, it is one of those quality premium players, which is well known for its construction quality. So, it's got a very good clientele base. So I would suggest, just hold on for the next 12, 18 months. Earnings growth for FY25 and 26 looks very strong. And I think if execution is all well, then I think you could expect a significant amount of re-rating.
All right. Let's take one more question and then we'll hit the rapid fire segment. I'll explain that in a minute. Ramya's got a question. She's bought at Oil India at a price of 527, 112 shares. Should she hold or exit is the question. Kush, on the charts, what does it look like?
It looks pretty strong. A couple of days of profit booking that we are seeing, that's all. But I think on the whole, on a strong footing. I think you should hold on to this one with a trailing stop loss at about 635, since your buying price is significantly lower than that. Continue to hold. There is a possibility that after this round of profit booking is over, the stock could resume its uptrend. But in any case, 635 is a strong support zone. So that's where you should have your trailing stop losses in place.
Avinash is familiar with this because he's done this on a show with me before. But just to explain to you, we'll spend 2 minutes on a rapid fire, gentlemen. We're going to try and take as many questions as possible. Kush, I understand you have to look at your charts, so I will forgive you if you take a little longer than Avinash does. Avinash, the first question is to you. IDFC First Bank. This has been bought by Rahul at a price of 76. Would you hold on to this? He's got a short-term time frame.
I think he should hold on. In the short to medium term, I expect that we could see levels of say 85 or 87. And I think bank has been doing pretty well. So I think continue to hold.
Birla Soft is the next counter. Kush, quickly look at the charts. The question is coming in from Bhupender. He's asking whether it's a good positional buy for the long term.
It is. A stop loss for this comes in at 625. The targets that you're looking at are 675, and once that is taken out, a 710.
Lemon Tree Hotels is the next counter. We're looking at a long-term question here. Srinivasa Rao from Vijayawada is asking, Avinash, can it be bought for the long term?
Yeah, I think if the investor has a 12 to 18 month horizon, Lemon Tree can definitely be purchased. It's a promising budget hotel chain, and I think it should do well. So definitely one can buy.
Z Entertainment is a counter, Kush. We're looking at a price of 150, acquisition price at that. I do not know the name of the person who's asking this, but can it be held for the next 3 months?
With a very strict stop loss of 125, there is selling pressure. If it breaks 125, then you could see further downside. So hold, but with a stop loss of 125.
Okay, Ramakrishna Rao is asking about SBI, bought at levels of 560. Should I shift to an index strategy? Avinash, he's asking, should he buy the index?
I think he should continue to hold SBI. That's the advice.
Okay, NCC bought at levels of 120. Would you hold or sell at the current rate? Avinash, are you familiar with the price and the counter? Would you hold on to this?
Yeah, I think longer term, I think I would continue to hold. If you have a 12 to 18 month horizon, NCC should do remarkably well. Very strong order book and very good execution. So continue to hold.
All right. Well, on that note, that brings us to the end of this very entertaining Ask Profit and insightful, informative as well. Thank you so much, Avinash and Kush, for joining in, for answering all the questions that you did. Viewers, we've tried, as you've seen, to answer as many of your questions as possible. We'll be back tomorrow to take even more of them. So do stay tuned. Lots more coming up over the course of the day. And this is NDTV Profit.